Today, folks, the Canadian real estate market is finally crashing. For all those you crying out there that wanted cheaper real estate, here's your effing opportunity. Don't be lazy, because we've had a 15-year bull run where you could not buy a house without an insane bidding war up to millions of dollars. And now you could be like me. I got a little preemptively. I jumped into this market, but I'm telling you, these numbers are crazy. Like, we're seeing some real corrections going on, and we're going to look at the actual stats. But more importantly, for those investing in the publicly traded market, I want to save you from massive detriment to your long-term returns and the corruption at the largest scale of these publicly traded REITs. I mean, just take a look at this. These are multi-billion-dollar REITs, by the way, the largest exposure you get to real estate in Canada, and Allied Properties is trading to levels we haven't seen since 2008. Does it look like 2008 out there? I know it's correcting, but these prices haven't jumped back 15 damn years. First Capital trading at levels you could have bought back in 2007. H&R, why is it trading at levels seen in the early 2000s during the dot-com bubble bursting? What? That doesn't make any damn sense. Plaza REIT, it hasn't gone anywhere since 2007. I'd be saying, Kyle, cash flow, we're buying it for cash. Nobody bought real estate in this damn province for cash flow. They bought it for the extended insane rally that we just went on, guys, when you were doubling and tripling your money over 10 damn years. Yet these REITs haven't done any of that. That doesn't make any sense. RioCan, this is the largest real estate exposure you can get to Toronto. It has the most square footage because it's a mall REIT. And I know malls are struggling, but man, I got real lucky with this one. I actually levered money off my line of credit, not financial advice, by the way, when I lost my job during the pandemic, and I loaded up on this sucker because I realized it wasn't dying, and I actually ended up making good money. We rode this thing up to like 20 a share and made a really good return. That's probably the best return you're ever going to see out of the damn real estate market the way it's going right now, because RioCan's trading at levels you could have bought in 2005. True North Commercial, here's a crowd favorite. This one was crushing it for a decade until it wasn't, of course. It was one of the highest yielders out there. I remember this used to give you exposure to like government buildings and stuff. Now the governments are like subsidizing those buildings. Smart Centers, here's another big mall REIT, building massive amounts of condos they probably can't sell right now, trading back to 2005 like levels. I get it. I know. I used to love this sector, guys, but sometimes you have to wake up. The writing is on the wall. The level of corruption in this sector is nothing short of astonishing. And you see the corruption, maybe, okay, I'm being hyperbolic. My level of corruption is these guys just taking fat checks, diluting, management fees, whatever you want to call it, right? Look at Canadian Apartment Properties here. This is the largest exposure you can get to basically family residential units, rental units, and it's done pretty reasonably well, but you still would have been 10 times better off just buying a property and not even renting it out for the last 10 years. Now, I did really like the industrial sector, and it has been not doing great right now. Dream Industrial, don't even talk to me about it. Granted, it's been a bit of an outlier here, but man, the whole point is you need to be able to buy a basket of these and perform, and you have not performed at all in this basket, but hey, at least Granite's done semi-okay. I mean, look at it. It hasn't done anything still since 2020. You'd have been better off just buying tech companies, guys. Chartwell, here we go. Here's one doing well. Oh my God, an all-time high REIT. And what is it doing? Retirement homes, baby. Because let's be real, none of us are having kids. We can't afford the real estate. We can't afford to house the kids. We can't afford to feed the kids. But so we're definitely going to be needing retirement homes, though, once we get a little bit lunacy in our, and we end up going into these places, or we put our parents in there, God knows. But look at the numbers on this, from 373 million to 511 million on residents. I mean, if you just look at the revenue for like the 3-month ending for the second quarter, 202 million to 273 million, 398 million to 526 on the 6-month. What is happening with retirement homes right now? Remember when these were like the detriment destruction of COVID, like just complete devastation, just like unfortunately, just wiping people out from that. And the people thought it was the end of the world for like retirement houses. And now they're just at all-time highs, crushing every single real estate sector you could possibly get exposure to, guys. Like, look, I'm just trying to point out the fact. I want to guide you on the path of least resistance to retirement. I told my parents this. Look, most people in Canada, I guess, except for the millennials out there in the younger generation, most Canadians have exposure to physical real estate, whether they own it or they have rental units physically. I would just say avoid the actual publicly traded market at all costs, because clearly something's wrong with this sector, and buy the physical real estate yourself and then invest in the United States, because U.S. real estate has been superbly less insane. It's just been so much more stable and offered way better cash flows. And don't overexpose yourself to the sector, because could you imagine owning publicly traded REITs and owning a physical piece of real estate? Your net worth right now is plummeting. This is why like you have to be diligent in understanding your exposure to these markets. But let's look at the Toronto the Regional Real Estate Board of Stats. This is nothing short of insane. And don't get me wrong. I mean, like I said, I bought a piece of real estate a couple years ago, probably preemptively jumped in a little bit too early. It's likely our values come down a bit. I don't really care. This is a long-term hold for me that's affordable, and I just hope that you can get in a very similar situation, especially now when there's no bidding wars going on. But let's talk about the residential charts here, guys. Year over year, what is happening? The residential transactions are down almost 10%. That's crazy. Seasonally adjusted, month over month down 2.3%, guys. Average selling price. Now, we've kind of gone through some cyclicality here because it went up a bit and now it's coming down again. But still, year over year now down 7.2%. Seasonally adjusted down 1.4%. Total new listings, guys, are up 2.7%. And yet the sales to new listing ratio is down 5%. This is your opportunity, guys. This data is insane. I mean, we haven't seen real data like this in a while. Days on the market are up 16%, double digits year over year. If I saw these kind of numbers on like one of my publicly traded companies, I'd be pretty damn happy. You get double digit returns, guys. You just don't want to see it as days on the market for your property. Like, oh my Lord, this is not a seller's market at all. Look at the numbers, seasonally adjusted figures here, guys. I mean, the sales here, we're trading at levels not really seen since the early teens. The teen years, man, what a great time to be alive. I mean, things were booming. Life was great. Politics weren't all that big of a deal. Markets were perpetually up into the right. Couldn't complain. Look at the commercial charts here. This is where things get scary, man. Commercial, leasing square footage is down 20%. You walked in any mall REIT right now, guys. I mean, I'm near Markham, right? If you've been to the Markville Mall, the amount of square footage that just opened up because Hudson's Bay went under. I think the Decathlon is gone. Toys R Us is gone. Like the insane. I would just like run for the hills right now. Sales are down 33%. Oh my God. If you were running a business and you saw these numbers, you'd be crapping your pants. Average industrial rate. So this comes back to like, you know, obviously Granite Real Estate Investment Trust down 13% year over year. Commercial retail square footage down 16%. We have seen a lot of industrial buildings come up, however. And this is what perplexes the hell out of me because, I mean, look at Allied Properties, but they had a lot of exposure to office real estate. The square footage is up 18.7% from $17 to $20. It's the only thing that's doing well. I don't understand why. Explain to me why. People going back to the office, you know, Dougie Ford out there really pressuring people to go back downtown where no one wants to be, dealing with that insane traffic. Screw you. I'll quit my job. I'll go find, you know, a work from home job. I'm not doing that anymore. Condominium sales. Here we go, guys. This is my world. Total condominium apartment sales are actually up. People are buying condos again. Look at that. Compared to last year, guys, hey, something's going on. But you want to see the average selling price? It's down from $693,000 to $649,000, a 6.4% correction year over year. Whew, baby, that's what you want to see. You want to see sales up, prices down. Great place to be buying, baby. The total new listings are up, or they're actually down 2.7%. Okay, so we see some reasonable data going on here. This is great data, man. I mean, it's nice for sure. Nice for sure to see a lot of people buying condos again at cheaper prices. Days on the market are up 18% year over year. Oh, the pain of the illiquid real estate market. You don't buy real estate for liquidity, do we, baby? Anyways, condominium rental charts. Let's see what's going on here. So total apartment rentals we're seeing on the market are up 20%. So that means prices are coming down. One bedroom down 5.8%. Guys, can you complain right now? This is what you wanted. This is what you were whining for. Prices to come down, rental prices to come down. You know, this is great. Things are flooding the market. Total new listings up 16%. Whew. Let's go. I mean, this is great. This again, like I'm on your side here, guys. Like even as somebody that owns a property here, like I'm on your side. I want to see these prices collapse. Heck, if they collapse enough, maybe I'll go buy another piece of property here in Ontario. I mean, it's not exactly the most landlord-friendly province, but this is the first time in 15 damn years you can walk in and knock on a door and lowball the hell out of them and likely get a sale out of it. Does that not excite you? This is the time to be alive, man. Go out there, hustle it. I know it's a tougher job market, but man, if you could just live cheaply, save up a down payment with interest rates dropping the way they are, this is the opportunity of a lifetime. At least in my lifetime, I've never seen stats like this ever. So I'm damn well excited. Like I said, I was preemptive. I jumped in the market a little too early. Don't really care. Like I said, it's super affordable for me. Hope it becomes more affordable for you. I'm sitting here, I'm praying. And again, do not buy. I repeat, do not buy publicly traded REITs in Canada. They're destructive. they screw you royally. Don't get overexposed to this market. Just buy a physical piece of real estate. If you want more real estate exposure, go buy the publicly traded REITs in the US. Stick to physical in this country. It's the only way you're going to do well. The data speaks for itself, but I'll pass that question off to you. How are you managing this in that comment section below?